Okay, let's just quickly check. Okay, everything is ready, everything is working. All of that. Good evening and welcome everyone. Just gonna give it a minute. I'm expecting about 10, 15 people. I just want everyone to jump in. Once everyone's in, then we'll get started. But for tonight, what we're gonna focus on is a trading plan. What's the importance of it, and integrating that just the basics of trading, understanding how market flows, and why it's important to have a trading plan. When you have a trading plan, you're consistent, you're disciplined, you have a set of rules that you follow to engage the market. So normally when people look at the markets, there's certain resources that goes about in terms of trading. The first resource is TradingView. You want to always be doing your analysis on TradingView. Now, TradingView is free software that you can access online. And if you just go search it, you're going to get access straight to it. So if you search tradingview.com, it's going to pop up like this. They have this new overlay and over front, and it's very easy to understand. Here by the top, you have the charts, trade, market that you can look at, cryptos, currencies, stocks, indexes, futures, bonds, and all of it. And then you also have screeners, so you can go look at forex screeners as an example and see at the moment what is the most performing pairs. You can choose what you want: overview, performing, oscillators, trend following, and you can also just go look at the overview. What is the best performance at the moment? And you most definitely see most of the major pairs. Now, major pairs are pairs that include the US dollar. If you're looking at minor pairs, it is strong currency like Australian dollar, the pound, New Zealand dollar, but it doesn't include the US dollar in it. So my personal favorite is the GU and also EU. Both of them has a very specific flow that the market goes into. And for tonight, what we're going to focus on is EU. So without further, I'll say full view. So as a trading plan or as a trader, when you go into a trading plan, you want to have certain things part of your decision making. You want to look at the market as a whole, and you always want to work from the 4-hour and understand what is happening with the market. So looking at the current market, we were bullish. Why? Because we created higher highs. Now, higher highs means that the market is just pushing up. Higher lows means the support are being kept, and that gives me an indication the market is going up and onwards. So that being said, you always want to trade with the trend. But once the trend is changing direction into a bearish market, so you can see we were bullish, up until this point here where we broke the support and pull back up, created a lower high. The market continued lower low, lower high, lower low, and we're looking to create a new lower high. You always want to trade with the trend. Now, that is one of the first things that you want to do when you start trading. You don't want to go against the trend. Like, let's say, for example, this bullish run here. If you were looking for sells, most definitely most of the trades would have a small movement, meaning 30 pips. That for me is an intraday trade. Now, in terms of trading, you have 3 different trading. You have an intraday trading, you have a day trading, and you have swing trading. Intraday is if you look at the market, you have 3 major sessions, and within those sessions, each has an 8-hour period that it flows. So 8, 16, 24, then a day is done. So those sessions are as I've labeled here above. If you want to see if everyone's in, okay. Yes. So those sessions are labeled here as above. You have the London, New York, and the Asian session. Now, London is also known as the European session, and it normally starts at 8 o'clock, South Africa time, what's it, 9 o'clock. And for London timing, New York opens at 1 o'clock. And then the session switches again for the Asian session starting at 12 o'clock. Now, you need to know this. So when you start to trade, you want to trade with the banks, think like a bank, trade like a bank. And in terms of your trading plan, you always want to trade with the banks. When you're trading off an account, let's use this as an example, and we're trading off a $1,000 account. You always want to risk a small percentage of the account whenever you're taking a trade. Because let's be honest, not every trade is going to be a winner. But when you win, you want to reduce your risk. That is the thing about trading, is you can aim for the moon. You can, like, I know there's a saying, people would aim for the moon. Basically, we're going to the moon. But if you don't hit the moon and you hit a loss, you want to reduce your risk. So my normal rule would be is you want to risk 1 to 2% if you're on a large account. If you're on a small account, risking 5% is also good because then you have a stable, consistent growth. So let's take, for example, this trade here. And what I'm looking for is just a dynamic support level. So let's say here about. So I'm just looking at this level as a support level. And let's say you take a trade based on that. And you have it's a bigger stop loss of 10 pips, just for example, and you want to go for 100 pips profit. So you have a 1 to 10 ratio. Let me just quickly fix this up. So 10 pip stop loss, 100 pip run. You have a 1 to 10 ratio. So you can see there your ratio is 1 to 10. So I'm risking only 5%. So meaning whenever I enter a position, I want to risk 5% of the account size. So if my account size is $1,000, I only want to risk $50. That means if I have a 10 pip stop loss and I'm trading Euro USD, for example, let's just quickly see. It's going to go on 0.5. I'll trade a 0.5 lot. Now, this is the thing about trading, is you can always see that you're going to make so much money, but you want to reduce the risk. And with your trading plan, if you want to know why you're entering, this is a support level. And it's a very specific support level. It's a support resistance level that's very dynamic. If I pull this through, you're going to see actually in terms of the chart work why this is important. Because previously it was resistance. Let's just do this. Previously it was resistance. And then it formulated as a supportive level. You can see price just stopped there and reacted on it. If I zoom out further, you can see there to the far left, this is also a previous support level. So it was a dynamic support, resistance, becoming support. We first tested the resistance, broke through it, and came back and then collected orders at that support level. And you can see clearly that the price pushed up. Now, when you're a trader, you want to identify risk management. You always want to have a 1 to 3 ratio on the minimum, as you can see here. So that means if you're risking 10 pips, you want to reward yourself with 30 pips. And that would be considered as an intraday trade. So as you can see, you have labeled it as intraday trade. Then a day trade is anything from 1 hour up until 24 hours. Now, sorry, some days you have a very volatile day, and you can see as an example here, with this 1 4-hour candle, market just pushed up, and the push into the upside was literally about 65 pips. Now, some days you get those rapid movements, and then the market just keeps on pushing up. Even here about, you have 2 4-hour candles, which gave a push of about also 65 pips. And then other days you don't have that rapid push, like as an example, yeah, based off these two candles, she had a 40 pip movement into the upside. Now, pips are just a percentage in profit. That's basically what pip stands for, percentage in profit. So if you were aiming for an intraday trade and you're risking 5%, that means it's $50, you're entering on a 0.05. Now, let's say you won a trade. You won $150. That means you're growing about 15% on the account, plus minus. And if you're going for a day trade, normally it would be 50 pips or even up to 100 pips. You're looking actually to increase your account by 50%. So you're risking 5% to grow 50% on one single trade. Now, identify how long it actually took us to reach 50 pips. Now, I can start from the starting point and at the ending point, identify how long did it take. 2 days and 4 hours. 13 bars, so it went 2 days and 4 hours to reach 100 pips. Now, that does not classify as a day trade. Day trade only goes up to 24 hours. If you don't reach your target of in 24 hours, it's not considered a day trade. Then it's considered a swing trade. A swing trade is anything that goes above 24 hours. A day trade, as it says, is literally just for the day. So if you were holding it for the day, you'll probably have a target of almost 60 pips. If you really stretched it, again, let's keep it conservative and say 50 pips. Now, still, same trade, you're just going for different targets. So 50 pips is you increasing your account by 25%. That's on one single trade, one single day. And this would all be part of your trading plan. So if you reach your target, you step out of the market and you say thank you and you're done. So when taking profit, sit back and wait for the next move. Now, this is what I said in the beginning, is when you analyze on TradingView. When you're looking to take a trade, you take it on your MetaTrader 4 or MetaTrader 5. Now, those two are linked to your broker. This is just a visual representation of what's happening actually on the charts. And in terms of your trading plan, is if you visually know you're trying to buy in a low and sell on the high, you have a better possibility of winning your trade. So let's say, for example, we had a support level and then price pushed up, create a higher high and then a higher low. Now this became the support level. Now I'm going to teach you something very interesting. As once the support is broken, this level of support is broken, most of the time that again becomes the resistance. So that was the support level. I'm just using it as a dynamic support level. You can see just the bodies to like just the wicks, I would say more of the relevant wicks. And then price push in towards it, pull back up, and then roll over, creating a new low. Now, I already know the market transitioned from a bullish movement or bullish trend into a bearish trend. Now, I don't just want to jump into the trade just because the trend is breaking to the downside. That would be foolish. Why? Because that's what most retailers do. What we teach you at Elemental Markets is not to trade like a retailer. We teach you to trade like institutional, like a bank. Now let's see. I know for a fact that you have 3 sessions and the Asian session starts at 12 o'clock. Now let's see. 12 o'clock here. Are we at price yet? No, we're not. Are we at the price where we can sell yet? No, we're not. So we wait for the fundamentals. Now fundamentals in terms of the Asian gets out at 2, 3 o'clock. Now let's go. 1 o'clock, 2 o'clock. Fundamentals are basically starting to get released. 3 o'clock, fundamentals are released. Now we still want to risk that 5% and gain. Basically, we're going back into, if I look at the 4-hour time frame, I want to see, okay, we broke the support level. What's the next support level? Yeah, this is the support resistance level that we used on the previous example. So we're just targeting that support region. We are aiming to capitalize on about a 45 pip movement. So let's go into the hourly time frame and see where's that support level. Yeah, about. So we are aiming for a 45 pip movement. Now, Identify, I'm still keeping within the trading plan. I told myself, okay, if I'm risking something, I want to have a reward of 3 to 1. And my lot management needs to be kept that I'm actually risking, I can say 5%, you can say 2%. There's a reason why I would say 5% is if you take a trade every day and you lose every single day for the full month, then only you blow your account. But if you're going to go and risk 10%, you only have 10 trades and so forth and so on. If you're going to risk 20%, you're going to only be able to take 5 trades. But I would say let's risk 5%. That means it's a 0.5 lots. And this would be in your trading plans. You want to say risk management, lot management, what you're willing to risk, and when taking profits, step back. That means do not trade again. Now, I'll tell you this. In my 6 years of trading, once you've taken profit of an impulse, market is not going to continue making an impulse. It needs to pull back, and then it can impulse again to the downside. Same thing with the upside. After the impulse, the market needs to relax a bit, pull back, gain some liquidity, wait for the next session, and then impulse into the upside again. Now, after you've taken profit, why would you jump in on the low, continuing with buy? That's just foolish. It's not going to help you. It's going to irritate you because the profit you just made, you're going to go back and just basically say, thank you, market, but I don't want this profit. Take it back. Until you learn that lesson of actually taking the profit and enjoying it and waiting for the next possible setup to trade, you're going to have a better potential entry. Now, using the same support resistance dynamic level, if prices pull back into this, we can say, okay, we're then looking for a sell and then continue to the downside. Now, what session are we going to look for? The Asian session. Seeing the previous trade came into the Asian session. Next trade, most probable, not always, can also come into the Asian session and sell to the downside. Now, let's look at the timing. From point entry, from the entry to the exit, how long did it take us? Was it a day trade? Was it an intraday trade? This one to profit was about a day trade. So if we go and say 24 hours, we didn't get the full 45 pips. We probably got 44 pips, took us 19, 20 hours. That's still conclusive in a more of a day trade. If you went for your intraday trade and you said this level of support and you went for, like, let's say 20 pips, you have a bad ratio. And I would not advise that. Why? Because then you're going for 1 to 2. That means if you have 1 win, you only need 2 losses to break even. If you have 1 win on a 1 to 3 ratio, you need 3 consecutive losses. That means you win, let's say Monday, you lose Tuesday, you lose Tuesday, Wednesday, you're still ahead with 10 pips of profit. Then you can make up on Thursday and say, listen, if I take another trade, I'm actually in the win. But if not, then I'm going to lose. So this gets you always having 3 steps forward, 1 step back. So if you take a loss, you need to step back and reanalyze. Now, that's something that I'll add onto the trading planners. When taking a loss, step back and trade the next session or day. Why? Because when you take a loss, your brain tells you, okay, I've just lost money. I want to make that back. That is the wrong mindset coming to the markets. You're not supposed to make money back. You're supposed to actually make money in the markets. When you're trying to make money back, you're pushing yourself in a loser mindset. And this is straight something that I'll tell you from the start. I'm not going to bluff you. Is when you try to take a trade based off revenge, you're not fully focused. Like, because now you can see the market's pushing up. Now you want to get into a buy, but it's a counter trend buy. But it's already halfway into the upside, getting ready to sell to the downside. But now your brain tells you, okay, market can push all the way up. No, it doesn't. We are on a bearish trend. Now, once it reaches the support resistance level, the market's just going to continue to the downside. But you're going to be greedy and try to stack more positions because you want to make up the losses and make profit. When you take a loss, step back, reanalyze, and trade the next session or day. You don't need to make all of the money in the one day. You don't need to make all of the profit in one day. You have literally a lot of cycles that goes through the market. So identify that and use that in your advantage. Because using the same plan, if I even go for intraday trade and I'm risking at 10 pips and going for that 30 pips, I'm still pushing myself forward. I'm still actually making a profit. So I'm still risking my 5%. And every single trade that I take, I follow those rules. Why? Because that keeps you consistent and disciplined. If you're consistent and disciplined, that gives you that edge over the market. If you're not consistent, not disciplined, then you're going to start entering the market at the wrong times, counter trend trading, not really moving forward. And then basically what you're going to have is you're going to start moving your stops into your 5% to your 10%, and you're going to really just mess yourself up. But if you keep to a trading plan and you're risking 5% to gain yourself 15%, you're actually moving forward. And that's the best way to trade. So these are just some rules that I would give you guys to use whenever you're in the markets. You can look at this and say, okay, if I start understanding what type of trader am I? Intraday trader, let's start there. If you want to intraday trade, you want to be in and out of the market very quickly. So to take profit, like let's say you didn't take it in the Asian session, but you took it in the London session, you would have hit target, let's say you'd have hit target of a 30 pip within 5 hours. That's the intraday trade. That's within the session. If you're not too patient and you just want to get out after the impulse, that's good. Because if you're holding for a 50 pip run, let's say a 50 pip run, you had to set a pullback and then a continuation. Even if you stretch it for like the next, let's say 75 pips, you had to wait for a impulse, pullback, impulse, pullback. So you have now two pullbacks, another impulse, another pullback, the third one, and then only on the fourth one, you reach your target. That means you are holding a trade over a period of 1 day and 14 hours. That requires a lot of patience and somewhat discipline, and that falls under the category of a swing trade. A day trade, you would have probably hit out by, let's quickly look at the timing. So if you went for 24 hours, there we go. You would have probably capitalized on a 40 pip run. Now, when you identify you're not a patient person by nature, do not go for a swing trade because you're really going to push your own boundaries and not focus on what you're supposed to do. But if you are someone who's patient by nature, push yourself. Say, okay, I want to go for day trade, but be realistic. What is the next support resistance level here? So if you are intraday trading, that is a very good target, support resistance level. 36 pips, not bad, because now you're pushing your reward. You're actually working with a plan. You're working with a specific plan. You're going and you're increasing your ratio. You're trading with the trend, so you can actually increase your ratio. But let's say you're trading against the trend, as just as a quick example, and you are hasty and you just had a loss because of some reason, stop loss was triggered and you follow the same rule. Let's say you have a 10 pip stop loss, but you're aiming to go back into this support resistance region. The market is not going that way. It's going downwards. You can see clearly overall. You broke the structure. Let's just do this for a second. You can see the market was going up and now it's going down. So why would I go and trade against the trend? I'm just looking for disaster. I'm just actually looking to start making losses. So you can have a cool entry, a good entry, but then only be in, let's say, how much? 12 pips profit. You have a 1-to-1 ratio, very bad. And if you take it out, that means you're trading with a very bad plan. And if you can't keep to your plan, then rather stay out of the market. Wait until there's a very good setup like this one here. If the price does come into this region, you can sell it to the downside, and that can actually give you a better risk reward ratio. And you're actually looking to trade with the trend. You're looking to trade with the institutions. So let's say we're going for that Asian session. Again, the 10 pip stop loss. Same rules apply. And I'm looking at the 4 hours. Now I'll go back into the 4 hours. Why? Because I can see the bigger picture that's at play. And I just want to go for 40 pips, saying this is my dynamic support and resistance level. And this is all that I'm aiming for. I'm just aiming for this level here. So I'm risking 10 pips again, about, let's say, I want to stretch it a bit, let's say 45 pips. Now I'm having a 1-to-4 ratio, and I'm willing to lose. Now, this is the main and important thing, is you're willing to lose $50. Because on the next trade, if you win, you make it back and another $100. That's the game of Forex, is numbers. So you want to identify what you're willing to lose and what you're willing to win. Because if you continue, you can actually make back that $50 and be ahead on $175. So this will conclude just the overall section on how to formulate a trading plan. If there are any questions you guys have, please feel free to ask it. I'll give you guys about 5 or 10 minutes or so. Then we can go over some questions. And then once we're done, I want to share a link with everyone. This gives you access to a specific course that myself and Moritz has created. And with that also, we are going to give you access to that for free. We're not going to charge you anything. We normally charge people for that. But because you guys are joining tonight, we're going to give it for you guys free at no cost. All that you need to do is just follow the link, and then you'll gain access fully. But for first, let's just go over some of the questions. If you guys have questions, please feel free to drop it. I'm going to share the links of Long in the description, in the chat box. Give me a second, I just want to get it. If you want, you can unmute yourself and ask straight away.
Miguel, my problem is the Asian section. That time of night I'm sleeping.
Yes.
How do I trade the Asian section?
Okay. So that's a very good and important question. So let's say you've already done your analysis. Like, let's say, yeah, I've already set up a trade, but I don't want to wake up at 12 o'clock in the night or 1 o'clock, 2 o'clock. London, it's in South Africa, 1 o'clock. The best way to do that is to enter, rather than by a order, you enter either buy or sell order, and you preset. You can already click on this and say, okay, listen, where should I enter my entry? 1.18420. Where should I enter my stop loss? And then you just use these numbers, because what happens is when the market triggers that order, it automatically enters it. If it hits stop loss, it automatically exits it, and when it hits TP, it automatically takes profit. That's the best way to go about it, and that's the easiest way to actually work with it.
Thank you.
All good. I've just dropped the link for everyone. If you want to, you can copy it into your browser. Just go through it. Once you're done, we'll send you the information what's it in regards to the course. Is there any other questions you guys have? Because other than that, I also have an announcement that I'll make before I end of the session. Yes.
Sorry, if I go and search for a specific pair, why is there a lot of the same thing? You go and search now in the symbols. A lot of Euro USDs. I see here from FX.
Sorry, can you just check your mic? I can't clearly.
Sorry, can you hear me now?
A little bit better, yes.
Okay, if you go and search for some pairs here, like I've searched now the Euro USD, why does it give me 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different ones?
Okay. Yes. So if you go onto your watch list, I'll quickly just give you an indication here. And you want to add, let's say, as you said now, you only want to add like Euro USD, Euro USD. Now, let's just quickly select all. What you have is the different brokers. Now, it's the one that I prefer is the FXCM. I'll say now why. But then you have FXCM broker by themselves, Forex.com broker, IDC is a broker, Capital.com is a broker. All of these are different brokers, and that's their feed that they give you. So if I click on any of these charts, they're going to be slightly different from the FXCM. Now, so the reason why we use FXCM is a direct liquidity provider. That means institutions, hedge funds actually uses FXCM to take trades on themselves. If you go on or under, what they do is sometimes they can increase the spreads. So that means the buying selling price can fluctuate, so that you're not always entering at the exact price that is shown here on the trading view. And that's normally does irritate a lot of people because you want to enter at the exact price that the market is at now. So my best advice would be is then use the FXCM and then use the broker that will be provided for you. If you're going to go and look at, like, let's say, for example, under, I'll show you the difference between the two. It really does annoy a lot of people because if I look at this chart now, yeah, let's just do this. It looks very clean. It looks very precise. There's no gaps in the market. Even if I go into the 1 hour, there's no real gaps. And if there's a gap like there, it gets closed. Under, look, immediately there's a difference. Look at it. You can immediately see there's a difference. And if I zoom in, you're going to see there's not that gap as I was created. Now that gap is normal because that's when the market resets after a weekend. And if I go into the 4 hours, you're going to see somehow the charts does slightly differ. This wick into the downside can be a little bit, I would say, more manipulated. The brokers has a certain percentage of manipulation that they're allowed to do. And if I scroll to the backside, let's see if there's actually a gap in the market. Sometimes the brokers does create a gap and then they leave it open. Now, most of the retailers normally has a specific strategy of saying this market always needs to close the gap, which is not always true. If a broker manipulates price, that gap will never be closed. Like here on the direct feed from institutions, there is actually that gap. Now that happened over the market reset hours, the closing of New York, and then you have a dead session. There's no banks open in that hour. And then they normally have this gap. But then as soon as the gap is opened, they close it. So in relation to your question, basically these are just all of the different brokers, and you can see the broker feeds based on each of them. So if you're trading, let's say on Capital.com, and you want to enter based on your analysis on their actual chart, then you just pull up their chart. Hope that answers your question.
Yeah, no, okay. So I've seen with Blackstone futures, I've seen that gap, especially on Sunday evening when you start to trade late Sunday night, yeah, at 11, 12, you know, to see that gap there.
Yeah.
Another thing, on top of your screen, there were your timelines. 5 minutes, 30 minutes, hour, 4 hours.
Yes.
At the bottom, is it same? Is it just a larger one?
Yeah, so this is just in terms of, so in terms of banking, you have a daily. So but when you talk to a banker, they normally talk about the daily high, daily low. And then you have the weekly, monthly, quarterly, and then what's bi-yearly and yearly. So this is just based on the banking. And then this is based on your preset. You can go here and change it, but this will be the default. So if I click on the daily, it's going to give me that daily view. But I can also just get it by clicking here daily. And then it's going to look, so let's just go here, daily, and I click here on the daily. You're going to give what you're going to get the overall picture on the 1 hour and see what happened with the whole day in relation to the charts on the 1 minute. If I click on the 5 day, you're going to get it on the 5 minute, what happened on the last 5 days. Same thing for the 1 month. So you have an overall picture of what happens on the whole 5 day time frame. If I go 3 months, then it's probably going to go into the hour. I can see what happened in the last 3 months. So that's the last quarter. And I can exactly see where price started, where price ended, and where price is heading up now. And this is an easy way just to have an overall view of what's happening in the market. But if you're analyzing, you're always going to use your own time frames. This is just if you go in and you talk in terms of bank, or you want to see what was the highs and the lows, you can click on this. But I'll prefer using these presets.
Now, just wondering about that.
Oh, good. Seeing I got 4 minutes left. I've sent everyone the link on the chat. I'm also going to post it on to the Telegram tonight once the call is done. So you guys can go and click on it. And everyone who also attended, what myself and Moritz are doing is we are starting to do signals also. We at first decided we're not going to do it, but we decided we want to get people involved in learning and also taking the same trades that we're doing. So everyone within the mentorship should get it automatically. But for everyone who joined in, who's in the public, will also get free access to that for possibly the first 2 weeks. And if you guys like it, you can contact us, either get in on mentorship or also just get involved within our trading. But we'll do these weekly webinars every week. But for you guys who joined in, I know there's a list of, I think, 9 people at most that joined in. You are going to gain access fully to the signals also for the next week. And these are trades that myself and Moritz take. So we're possibly going to send you our analysis and then say, okay, listen, we're taking a buy or sell accordingly. And if you want to learn how we send out these signals, what's the trading behind it, you can just contact us and we'll help you either get in on the mentorship or get in on the on the different courses that we currently offering. But just from my side, thank you guys for joining. It's highly appreciated. Other than that, hope you guys have a good evening, and then we hope to see you on the next on the next weekly webinar.
Thanks.
Okay, thank you.
Thank you, gents. All the best for your evening.
Excellent. Thank you.
Bye.